for my trigger of the week. My swim goggles. Because I'm getting back into what I truly enjoy, which is swimming. I'm making swimming my job. I'm an Aquarian, by the way. Did I ever mention that? I don't think so. I love the water. I love living near the water. I love swimming. I love everything about the water. So I'm so happy where I live. I just don't want the water in my condo. So let's hope this hurricane season is not as bad as the last. Because I shared with you that 31 units here at my community flooded. I know I talk about it way too much, don't I? I need to stop talking about that so much. Anyway, so welcome back. Today is Friday, March 21st. And I think the title of today's episode is My Final Preparations for Parking Money in Low-Cost Index Funds. ASMR style. ASMR. 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 Because I feel like I kind of left you hanging. Remember last Friday, we talked about the fact that the month of March, again, I'm making those final preparations of where my money's going to live because I kept vacillating back and forth, back and forth. Do I want all my money at Vanguard? Do I want all my money at Fidelity? Or do I want a blended approach? And I finally decided on a blended approach. Thank you very much. So I just felt like that would be the best of both worlds to leverage the fact that my company, remember, moved us over to Fidelity. So what I did this week, I met with the advisor at Fidelity that I told you about. And actually I met with him twice. Let me tell you what happened in the meeting that I was about to go into after last Friday's episode. So I met with him again. And I said to him, listen, the mutual funds that you wanted me to go in had a higher expense ratio. And I would be paying about $3,000 or $4,000 more per year in expenses to own those, but they really did not outperform the target index funds. Remember, index funds ride the market, and they are not managed funds. They're index funds. And I've never been a believer in managed funds because why? The expense ratio is a little bit higher. So let me see if I can remember what it was. Do you guys remember? The managed funds were about 0.6, I think it was, yeah. So just over 0.5%. Still super low. Don't get me wrong. Super low expenses. But I wanted even lower than that, which was 0.12. And some people would argue, oh, you should get a mutual fund that has a 0 expense ratio, which Fidelity does have. But I could not find them balanced, with stocks and bonds. I didn't want to go get lots of different mutual funds. I just wanted one fund. So I chose the target funds, the index funds, above what his initial recommendation was. But let me share with you that in that call, I said to him that I truly believe in index funds. And he finally came around. He said, you know what, Evan, he goes, you're on top of your money. And remember I said that in a traditional IRA and a Roth IRA, you can move your money into different index funds at any time with no tax implications whatsoever. Not that it's a good idea to do that all the time, but because like I said last Wednesday, you want to be a buy and hold investor. But as we go along, I can always change those funds into something that is either more conservative or more aggressive. I can do the balancing myself in one way, if that makes sense, rather than having those funds that were managed. So he agreed with me. I could not believe it. A true fiduciary would understand that I was adverse to paying that much in a mutual fund. And so he said, great, I agree, that is what you should do. And again, because they're not managing my money under assets under management, all he can give me is advice. And I said, okay, great. So that is what I chose to do, which is for that 850,000, which, by the way, you guys know the market has come down quite a bit over the past week or so. So it's not 850, it's 820, 820,000. And originally I thought, you know what, maybe I should wait until the market comes back up to make this move. And the more I thought about it, the more I Googled, the more I talked to people, I realized that it really is 6 of one, half a dozen of another. It really doesn't matter, because yes, my 401k lost $30,000. It went from 850 to 820 because the stock market, the S&P 500, went from like 6,100 down to whatever it is, 5,700, somewhere in there. I can't remember, but definitely went down. So I'm selling those shares because what they do is they move you to cash, but I'm only out of the market like less than a day. I immediately moved it into those other funds. The 60-40 for the Roth, because I'm going to need that money in about 6 or 7 years. And then 85-15, believe it or not, for the traditional IRA. So very aggressive. Why? Because I don't need that money for 15 years. So, because you're selling when it's a little bit down, however, you're purchasing like index funds, stocks, in other words, equities and bonds, when they're low as well. So you're buying low, which is good. Then once the market goes up, it's going to go back up. So does that make sense? Now, if I would have taken that 820,000 that was down and just put it in cash, that would be stupid, right? No. You'd want to wait till it gets back to 850 and then sell it all. So I decided to go ahead and do that. So now that March will be coming to a close, I met my goal, which was to figure out where I wanted this money to live. And I'm going to leave you with this in today's episode. This is a really good problem to have. Oh, and by the way, before I get into that, I will go to Personal Capital Empower, and I'm going to put in those mutual funds and figure out my overall asset allocation, and I'll share that with you. It's probably not going to be too much different than where it was before as a result of making this move. So I'll do that in the next several episodes. But, you know, as you go into, hopefully for you guys, early retirement, what you start thinking about, especially before you get to age 65 when Medicare kicks in, is healthcare. That's the number one obstacle, I guess, is because the Affordable Care Act is still here. I have to figure out how to qualify for the subsidies in the most tax efficient way possible. So, I mean, think about it this way. Age 59 for me is right now, 2025. I think I shared this with you before, but I'm okay making sure that I have at least $16,000 of income in terms of the IRS, because I had some paychecks in January. I've got YouTube income, interest income on my CDs and money markets will also qualify. So I know on my spreadsheet that I have that I'm right there. I won't have to really sell shares in 2025 to meet the $16,000 to qualify for healthcare subsidies. But 2026 is a different story. I really won't have much income other than the interest income that I just shared with you on those accounts, as well as YouTube income, whatever that may be. So I will probably have to sell some shares from my taxable account. Remember, that's what you historically would go to first, to make sure that I then have enough to qualify as income. But here's what I'm figuring out is I'd have to take at least like 30 grand off of the taxable account, or maybe a little bit less, but that then goes into your checking account. I use that for expenses. Then at the end of 2026 is when I pay the tax on that 30,000. It gets very confusing. So you spend the 30, but where do you get the 6,000 or whatever it is to pay the tax on that money? Maybe the Roth IRA could use to fund that, right? Because then you have that money that does not really count as anything and you can use for anything you want. Seriously, a good deal. Just anchor back to Wednesday's episode that you want to have some after-tax investments, hence the word, the Roth IRA, which is what that is, to have these opportunities and choices and options in retirement. So, that's what my life is all about right now. Aside from, the personal side, getting back into perfect top shape, feeling relaxed, etc., I'm navigating these first few years, which is really exciting. Age 60, 61, 62, 63, and 64. That's 5 years. If Obamacare, the Affordable Care Act, is still around, okay? But, I told you I have a friend, Michael, that we go to dinners, and I said to Michael the other day, I'm like, Michael, when am I going to be able to spend all this money if I'm so frugal, right? If I'm always trying to be tax efficient, keeping my income down. Yeah. Now, right in the middle of that, from 60 to 65, is what? The fact that I'm going to take Social Security early at 62. So I have to navigate that as well. So that part of Social Security income qualifies as income for the Affordable Care Act as well. I don't know the details yet, but that is something I will also have to navigate. So I'm going to leave you with this. I made the final preparations for my money. It's going to live in 2 different places. I'm completely happy with that. And it's also kind of funny. A lot of my friends are like, Evan, maybe you should have just worked. And a lot of people do continue to work even though they don't have to, because they don't want to have to learn the things that I'm sharing with you guys right now. It's kind of a funny joke. It's like, okay, I might as well just continue to work because I can't figure all this healthcare stuff out, right? But again, anyway, it's a good problem to have. Hopefully, as you guys get older, you'll be able to leverage different accounts, put your money there, and learn as you go. By the time you guys get to my age, if you're a lot younger, the rules will change. Things are constantly changing. And that's what personal finance is all about. That's what financial independence is all about, is having the courage to face the obstacles as you get older and you pull the trigger, where work is optional. And that's what I chose to do. And that is what I wanted to leave you with on today's episode. So have a great weekend, everybody. If you like content like this, give me a thumbs up. Consider subscribing if you have not done so. I appreciate you guys. I believe in you, and I congratulate you for every step of the way. And I'll see you next time.